First off, just want to thank everybody for joining us today for our new buyer workshop. This is our third one so far this year, and we've had decent attendance so far, and we're super excited to continue to share our industry insights and help you be prepared for the spring market or whenever you choose to buy. And so today, I hope you find that we're going to, we'll show you sort of what are the key steps and what are some of the key things that you should be considering and sort of preparing for as you begin the buying process. In addition to that, just to give you a little bit of a background on who we are, so Poljan Properties is a independent local real estate broker, right? I've been in the industry for just over 12 years. I used to work for Corcoran, and then about 7 years ago, started up the company, and now we've expanded. We've got an office space in Titmus Park, and our reach, though, goes far beyond that. We have a number of listings up in Harlem, Queens, Manhattan, and Brooklyn, so we serve all of those areas. And over the last 12 years, we've sold over $100 million in real estate, and I think a lot of that is due to the fact that clients see us as being a true partner and a broker for life. So, with that, one of the things that we pride ourselves on is client service and customer service and education, right? And market knowledge. And so that's what we're going to share today. And so thank you again for joining us. With that, Danny, I guess I'm going to turn it over to you.
Okay. Thank you. I'm having a hard time sharing my screen right now. I'm just trying to get back access. Just bear with me 1 second.
Well, while you're doing that, I might as well continue to do the song and dance. Right?
Yeah, thank you, Peter.
So what we'll do is we'll talk about the market a little bit and what are we seeing. So far, the market is pretty strong here this spring. We have seen that there's a lot of folks that are a little, I wouldn't say worried, but they want to take advantage of the market before interest rates begin to increase to the point where it could be, I wouldn't say necessarily prohibitive, but just more expensive. And so, depending upon the areas and the type of products, we are seeing some bidding wars out there. That's one of the reasons that we think it's super, super important to get prepared so that if you do find an apartment that you like, that we can move quickly. And oftentimes, if even a couple of days can make a difference. So that's part of the reason that we're having today's discussion. I think the other thing that's driving demand this spring is that for the most part, people are kind of over COVID, and I don't want to be dismissive of COVID or anything like that, but there is just a general sense in the market that folks are really, really yearning to get back to normal, whatever that is for them. And part of that is, if they've been able to hold on to their job and they've been living in New York for all this time, they've decided that they want to put down roots and they want to, establish a life that might have looked very, very different prior to COVID. So I think those are some of the key drivers in the market. Danny, how are things going on your end?
We're very good here. So thank you for that.
Yeah, you bet.
Yeah. So thank you for the introduction, Peter. We are an independent brokerage, Poljan Properties. We're located down in Titmus Park, Brooklyn, and we work with buyers and sellers in co-ops, condos, townhouses, you name it. We're here to help you. So the purpose of today's workshop is to give you a little bit of an insight on what to expect through the buying process in New York City. So as we mentioned, co-ops, condos, townhouses, New York City is a different market than most other markets in the country. And it is to your benefit, I would say, to have a great team in place in order to meet your objectives. So that is the first step, to determine what are your objectives? What's your timing looking like? Are you currently renting and you're looking to build some equity in a home purchase? Do you currently own a place and are looking to downsize or upgrade? Those are things to determine. Another thing to look at is your financial capabilities. So you're going to want to talk to a great lender such as Michael Stein, who we have here with us today, and determine what is it that you can afford. Where he's going to go over what's pre-qualification versus a pre-approval. And then once you've figured out what price range you should be looking in, you can determine what property types, what location, number of bedrooms that are important to you, if the building needs or doesn't need amenities. If you have a cat or a dog or multiple, note that many co-ops will allow cats, but maybe they won't allow dogs. Maybe they won't allow any pets. So these are things to consider as well. And as I mentioned previously, you're going to want to assemble a great team. So that starts with your real estate broker, that's us, your mortgage lender, such as Michael Stein, your real estate attorney. We have Eugene Sarantis with Weidenbaum and Harari with us today. He's going to go over through some great information. You're going to want a great attorney on your team. You're going to want an inspector before you settle on a property to ensure that you prevent any big headaches from coming up later on. And then you're also going to want an insurance agent to make sure that you have the proper insurance for your property. Once you have all of that determined, it would be great to go and discover neighborhoods, areas that you like. Maybe you have friends and relatives that are in a certain area you want to be close to. Maybe you want to be close to work. You want to have an easy commute. You enjoy frequenting certain restaurants, et cetera, et cetera. Now is the time to determine where you want to be or where you don't want to be. So it's also good to rule out areas, neighborhoods that you don't maybe enjoy, or maybe buildings that aren't your type. And then, as you're looking through online, you can look on StreetEasy, Zillow, et cetera. You have us as a resource to look through listings with you. We would set you up in our database and share listings that fit your criteria. And then you're going to look through a number of listings and figure out what are the high potential properties. And then once you've sifted through a number of listings out there, you'll eventually find the one, and then we will work on how to get that one for you. This time, I'd like to turn it over to Michael Stein. And Michael is a lender that we work with pretty often, and our clients have a great experience with him. And Michael's with Wells, and he's going to walk us through a little bit of the process on how to get pre-approved and what the mortgage process is like. Thanks Michael.
Stan. Thanks again. I wanted just to kind of add on to Peter's comments about the market, and to give you my thoughts behind it. And it truly does show that people are making a good amount of money between salaries. I've seen increases on salaries, bonus, and commission. And I also seen brokerage accounts increase substantially, which during those 3-4 years, etc. So there's a lot of money that's out there, and even if borrowing starts to increase, which it has, I still think that it's very affordable. When you're looking at the terms of renting, and Peter, you can kind of correct me if I'm wrong, but I've also seen like discounted on rents, which you kind of like lure somebody, get somebody in to lock them in for a year or 2 years with a lower rate, but that could end up, seeing like an increase significantly the next time around the lease is up. So when you're looking at a mortgage perspective, which I'll get into, there's still good timing now to jump in the market, to see what you can do, see what you can afford, even if borrowing cost increased. Maybe there's an increase between, $300-400 on your mortgage because rates have gone up, might still be very attractive compared to maybe looking at rents. So that's like a benefit. Plus the fact that, mortgage interest is still tax deductible up to $750,000. So there is a tax incentive for customers to look at that option. So I kind of want to give you, yes, cost is going up for borrowing because it has to offset inflation. There is inflation out there. I'm sure some of you are probably reading up on that. The Fed has to control that. When inflation is increasing at a very fast pace, the only way they can do it is really kind of increase the short-term interest rates, and then that's going to have an impact on mortgage rates. Doesn't mean that you can't like borrow the money. It still is available to you. It's just that you're going to see a slight increase on your mortgage payment, right off the bat. But historically, just so just to give you historic numbers, back in 2000, we were offering mortgage rates at 8%. And then in 2010, after the crash, you still had 6% interest rate on a 30-year fix. And then in 2020, you went down to 2.875, for about 2 years, I would say. And then in January of 2022, the Fed's like, okay, we got to start to offset, inflation. And once that occurred, the interest rates start to climb. I think they climbed pretty quickly, but still, I think that if you look at the payment and look at and compare it to a rent, I still think you're going to be better off in tax reason wise to actually take a mortgage off. And I can go through all that and qualifications, etc. So, that's the kind of the point that I want to bring, is that even though that borrowing is going to cost a little bit more, I still think that people are making a good amount of money. Employers are sending it. There's low employment. There's a lot of jobs that are out there. So it's a huge opportunity to still take advantage, get into your own apartment, or even a home, whichever you prefer. And that's kind of what I'm going to go over with it. I know some of these slides are going to be, it'll go through, Wells Fargo slides. And Dan, I'll just kind of like go through, but I'm going to kind of like pick out some slides that I'll go through qualifying, when you're deciding to buy. This is kind of like important to read through. Your mortgage payment, is going to the equity of your home. I mean, that's incredible because, there's, when you retire, you want to have like a no mortgage, of course, and you want to have equity, and that's also a nest egg. You got to look at it as a nest egg. You're diversifying yourself by buying a home. That's another way to kind of look at it, but it's truly your home. When you're paying rent, you're actually paying somebody else's mortgage. That's kind of how I look at it. There's no tax, advantage of renting. Maybe it's a peace of mind, maybe they have some rent that you secure for 2 years, but once you're locked in, they usually normally increase those rents. But on a 30-year fixed mortgage, you'll get locked in, exactly what you're going to pay. Usually requires upfront financials towards the commitment letter. I'm just kind of going there, just, homeownership is long-term commitment. You can have it for 30 years. And the great thing about Dan and Peter, they know the market in Brooklyn. I know the market in Brooklyn. It's great to start into, let's say, if you're looking at a studio or 1 bedroom, you're getting comfortable with, paying a mortgage. I mean, that's what kind of like the beginning stage is. And then after you get comfortable and you see that, oh, wow, my income is increasing, you kind of go to the next step because maybe your lives have changed and, you have a family now and you need more space. And then you go to your next apartment. So that's kind of like staying and engaging and keeping in contact, with Dan and Peter and myself, is because there's always something that might come up that you might have to sell or you need some more space. So that's like very, very important. And then, going through the qualification is that when you're talking to a lender like myself, is that you want to make sure you have all your documents ready, all of your income, your pay stubs, your W-2s, your bank statements. The bank is going to ask for all this information up front because we want to know that, the information you provide me on an application, is that correct data? I want to know for sure that if I'm going to pre-approve you as as a buyer, I want to make sure I'm going to execute that in the end and you're going to get the apartment that you truly love. And that's why you have to be fully involved, understand that the bank is, fully regulated by the federal government. And yes, we do request a lot of information up front. So that's your expectations. You got to make sure that you're getting all the necessary documents up front. When you do that, it's an easier process to get through the system, to get into underwriting, get your loan approved. You get an appraisal done because we have to make sure that, the apartment that you're buying, it's truly worth what you made an offer on. Now, granted, there's bidding wars, like Peter mentioned. If you truly love it, then you might go above the listing price. But an appraisal is important because the bank wants to know that what you're offering on this apartment, is it truly worth it? And you can go through, whether, if it comes down to, the appraisal comes in a little bit less, we could always talk about, hey, how do you make up the difference? Sometimes people might have to put down a little bit more money, but normally when you're talking to Dan, you're talking to Peter, they're giving you the full scope of what the property will be worth. Will it come in a little bit higher? Should you go a little bit higher so that you can get the apartment that you truly love? That's that's what they're going to do. So getting down into the ratio piece of it. Now, how do you know, if you're going to qualify? The bank's going to look at your gross income. And they typically want to make sure that when you take out a mortgage and the monthly debt obligation that you pay doesn't really exceed 36%. I mean, can we go higher? Yes. I mean, I've gone up to 42%, 43%. but sometimes you might not feel comfortable as a buyer to go that high. So I think it's like critical for you all to know that, what might be comfortable in your eyes is to look at the payment, give a suggestion. Hey, I'm comfortable with maybe $3,000 or $3,500. I can work backwards and say, hey, this is your max purchase price, but then maybe you might go a little bit higher and you're comfortable knowing that your employer might give you a raise next year and that all of a sudden you're going to see a bump up in your pay. So those are things that you want to look at, is that the banks, yes, look at a 36%. So if you take your gross income and multiply by 36%, we just don't want you to go above that, because then, it might be more challenging because things do come up. You might have to get a car, or might get something else. Like, we want to make sure you have some room to work with, instead of just paying all of your money towards, your housing. Credit basics, you go into the next slide, Dan. In terms of credit, you want to make sure your credit is between 740 and 850. That's where you're going to get your best rates. So when we talk about this, always make sure your bills are paid on time. I tell customers, if you spend it on a credit card and you're using it for points purposes, the next day just pay it off, because maybe you have the cash to pay it off. Don't wait for the actual bill to come. Just go in and pay it off, because what that does is actually tells the credit agency that you're managing the debt you take out, and then you're paying it immediately off. So when it records to the credit agency, it shows zero balance. When it shows zero balance, you're going to see a much higher score. So make sure that every bill is paid on time. Use auto pay if you're very busy at work, etc. So that's very critical towards when you're applying for a mortgage. How to improve it, I kind of went over that. Always make sure your revolving debt, your credit card debt is minimal. Pay it off if you can. Automatic payments, like I just said. Do not open new accounts, because that can have an impact on your credit score during the application process. And just make sure that if you look at your credit rating, just see what you're doing. Like, just continue doing what you're doing, because the banks only pull your credit once typically during the process of a mortgage. If you do a pre-approval, it means that your credit is only good for 120 days. So home finance basics, go to the next slide. The next thing is, just some components of a mortgage payment. You're paying principal, you're paying interest, taxes and insurance. And in case in New York, you're paying, common charges, or maintenance is what they call it, depending on if you're buying a co-op or a condo. I know this presentation is directed towards homes, which is not really directed towards our market. So just kind of bear with me on this. It's, our market is all about condos and co-ops. And, if you go outside, then maybe you might have a townhouse that you're looking at. So, just bear in mind that we are looking at co-ops. It's a great thing about co-ops is Wells Fargo has a tremendous database to look up the co-op before you even make an offer, just to make sure the financials are very strong. So use me as a resource when it comes down to that. What you need to do to make, your down payment, larger down payment, you have a smaller down payment. Everything it just determines that monthly payment obligation. You can make smaller down payments on a condo. I've had customers do 5% down. So you don't have to do the necessary 20%, because everybody says 20%. That might be for co-ops. Co-ops have their restrictions as well. But on condos, you could actually put down less, depending on the purchase price. If the purchase price is within, 800,000, you could technically put 5% down on that. The rates are going to change, and you probably have to pay insurance on that. So you just have to look at the monthly payment obligation, and is that something that you want to do? That's what my job is for. It's just to kind of go over that, be upfront with you, service you, let you know what's going to work, what's not going to work, how to help you. Like that, I'm just advising, like I'm helping. I'm not just only, giving you options on products, but my job is also to help you and create, the comfort level to knowing that I can get the loan done and service you and answer all your questions. And like I said, like I mentioned to you, less down payment, that's when you want to ask me, to price out those loans. How can you save for down payment? Pay yourself first, put it into a brokerage account, put it into, a high yield savings account, which could be mutual funds. That's why you might want to get a financial advisor to help you with that. Savings account, you're not really gaining any interest on it. So there's, you just have to make sure that you're taking some of your money out of your paycheck and putting it aside, to buy a home. And that's kind of like next slide. You can keep going on that one. what are the loan options out there? There are fixed rate mortgages, there are adjustable rate mortgages, FHA loans. I don't do too many FHA loans because we do have a lot of conforming loans, agency loans, which allows you to finance 95% financing, and it's cheaper for customers. FHA loans usually work well if the credit score is a little bit lower. I look at the payment. I look at which payment's going to benefit you as the buyer, so that you feel comfortable purchasing the home. We have VA loans. There's jumbo loans. Jumbo loans is anything above $647,000. So if you're buying something for $1 million, I would probably reference that, it's a jumbo loan that you should apply for, and these are our rates. Loans for, newly built homes, you're not going to necessarily see too much of it unless, you're buying in new construction condos. We offer loans for those type of developments. But for newly built homes, yes, if you're going to build a home, we could finance it after fact. So next slide. How much I could borrow. So basically on pre-qualification and pre-approval, I really suggest customers to going with the pre-approval option because, A, you want to know what the credit is, and B, you want to get the data, which is how much is your income, how much assets have you saved, because, Dan and Peter want to know exactly, what's your buying power, just to it helps gauge like what apartments are going to best suit you, in terms of payment and price point. The pre-approval, I think, is ideal to, get you a better understanding of what you qualify for. And that's overall my job by looking at the information you provide. Next slide. Keep going. Let's see, what is the steps around buying? Let's go in here. What steps of financing? It's my job is like, once you get to a point where, hey, I really want to engage and want to get into the process, you apply for an application. There's an online application site that I send you to all customers. It's very easy to navigate through. Once that is completed, I can pull through the numbers, and then as long as the data meets the lending policies, a pre-approval is actually issued. But then in turn, I will advise you to make sure to upload all of the necessary documents. Next slide. What should I do during the loan process? I provide actually, updates where the Wells basically has put to a point where they implemented to make sure that customers are fully aware every week what's going on, maintain that, communication level, because, buying a home, it's a huge financial obligation for you. So we want to keep you active and keep you up to date and let you know exactly what information is still needed to clear that loan. So that's like our job, and that's my team. I built my team to make sure that we service you to the highest level, and that's what you're going to get. And how can Wells help you? And the next step is basically, my information is right there. I mean, I know I threw out a ton of information. I've been with Wells Fargo for about 17 years. I've been in the industry for 20. So I have so much knowledge and so much experience towards all the cycles that we've experienced so far, and what we're experiencing today is, I do believe that, salaries and bonus and commissions have increased. And I think borrowing has just slightly had to increase because of inflation. It doesn't mean that you're not going to be able to qualify. It just means that the borrowing is a little bit more, but you're not always stuck with that loan. Just recall, like if you buy and let's say the interest rates drop, you have every right as a consumer and a borrower to refinance that loan to get the lower rate. So you're not always stuck with the 30-year fix for the rest of your life. You can always get out of it and refinance. And that's what occurred in 2019 and 2020. People just kept refinancing their loan to get the lowest possible rate. So don't think that you're always going to be stuck, with the current rates. You can easily get out of it. And that's why we offer adjustable rates. Some people take 10-year arms just to get a lower rate than the 30-year fix because they might decide that they buy something bigger, or it's just a starting point. Those are the things that I'm going to ask questions. I'm going to engage and see what your thoughts are, what's your goals, what's your financial goals. I mean, that's what you're going to get. For me, it's just, a wealth of knowledge. I can look up buildings. Dan and Peter and I, we have done plenty of deals. They know how I work. I'm very proactive. My team is built that way. And I just feel like, I just know a lot of internal, underwriters and leadership, and, and we doing what's right for the customer is super important. and that's why I've been, with them for so long.
Thank you so much, Michael. That was very, very helpful. Michael had tons of great information there. I recommend once we send out this recording, rewatch that, and you're free to reach out to Michael, to me, to Peter, to anyone on our team, and we can chat through this some more. So thank you again, Michael.
Not a problem.
Now we're gonna walk through the next step. Once you have your financing in order, you know what it is that you can afford. And you found the property that you love. We're going to work on negotiations. So there are a number of terms that go into the offer. So we're going to look at price, obviously. In a competitive market, we're seeing times where we have to go above the asking price, but maybe we can try to negotiate on some other terms. Every situation is different, so we would have to look at each one and assess. So one of the things you can negotiate on price. You can also, if there are any, say, fixtures in the apartment or the home that you like. So if you love the chandelier, we can see if the sellers would be willing to include it. That can be something that could be negotiated on. Closing date is another item. Maybe you're super flexible on closing, but the seller needs additional time. So that could be an accommodation to try to help out. And another thing that we can negotiate on are potential concessions. So in new developments, what we'll see is that the sponsor, so the owner of the new development, who's selling off their units, they expect the purchaser to pick up a number of closing costs that otherwise on a resale, the seller would be picking up. So an example would be the seller's attorney fees. That can be, anywhere from $2,500, sometimes we'll see $4,500. You'll see different numbers depending. And then also the New York City and New York State transfer taxes. So typically the seller on a resale will pick that up, but the sponsor for new developments wants the buyer to pick that up. So one of the items that we would negotiate on is to see if the sponsor can pick up those closing costs. And then once we've come to an agreement on what we want to submit, we submit the offer with all the terms, your pre-approval, a financial statement showing your assets, your liabilities, your income and expenses, so that the seller can see that you are qualified and have confidence that you will be able to close. And if you're paying with cash, or if you're buying with cash, we would show proof of funds. So whether that's a bank statement or a brokerage statement. And we'll go probably a couple of times back and forth on the negotiation. And once we have an accepted offer, we will notify your attorney. And once we notify the attorney, such as Eugene Sarantis, who's going to be speaking any minute now, they are going to perform due diligence on the property. And that includes looking through offering plan, amendments, buildings, financial statements, board meeting minutes, et cetera, et cetera. And as part of this due diligence process, we will also conduct an inspection if you do want an inspection. Rule of thumb, if on co-ops and condos, it's nice to get the inspection. On houses, or townhouse, I would say 100% of the time get an inspection, because you are on the hook for anything that can go wrong in that house. Where in a co-op or a condo, you do have a board and a management company to take care of the building itself. So, most of the time it's nice to get an inspection, but it's not 100% necessary. And once you're comfortable with your due diligence, you make a go, no-go decision. And at that point, once you sign your contract, you will be submitting a 10% deposit, which will sit in the seller's attorney's escrow account. And at this time, I'd like to introduce Eugene Sarantis. He's an attorney with Weidenbaum and Harari, and he has been taking care of a number of clients for us. And I'm super excited to have him speak to us today. So thank you, Eugene.
Hi, Danny. Thank you for the kind introduction, and good afternoon, everyone. First off, I just want to thank Danny and his team for having me here today, and just a testament to the great work that Danny and Peter constantly do over there. And also Michael, I've had the pleasure of working with these gentlemen on several transactions now. Always a pleasure, always a smooth transaction. All right, so today I'll be talking a little bit about the differences between condominiums and cooperatives, and then also a little bit about the difference in closing costs between the two, and the process of getting from the point of an accepted offer to closing, kind of what Danny just started to touch on. So first off, in a condominium, when you're purchasing a condominium, what you're buying is considered real property, okay, and it is conveyed by a deed. A cooperative is a little bit different. In a cooperative, you're buying what's known as shares of a corporation, which is in the form of a stock certificate, and you're getting a proprietary lease to live in your specific unit. So there's going to be several differences in real property law between the two. That is mainly for the attorneys to worry about, but definitely something that clients, buyers and sellers should be aware about. And the other major, I mean, in the eyes of the IRS, they're viewed exactly the same. So not too much to worry about there. When you're purchasing in a condominium, it's the board application process, and Danny would know a little bit better about this than myself, but the board application process is relatively more straightforward and not as subjective. Whereas in a cooperative, you're at the mercy of the board. The board can reject the sale for any reason, and they don't have to give you a reason. With a condominium, you also have the right to resell with limited restrictions, whereas a co-op, there's going to be certain guidelines for the purchasers, and there also may be things such as a flip tax, which is could be a fee or a percentage of the purchase price that when you sell, you have to pay back to the corporation. Now, you might be thinking, okay, we're all looking to buy, so why would we care about that? You would care about that because if you purchase a one-bedroom, you may be looking to sell it one day. And I wouldn't want any of our buyers to be surprised when they go to sell their place, they find out that there's, maybe a 1 or a 2% flip tax. I would want them to know that from the time of purchase, so they know exactly what they're getting themselves into. With both, you're going to have to submit a board package. And then with a condominium, what you're going to get is called a waiver of right of first refusal from the board. That is what is considered your board approval. With a cooperative, it's going to be slightly different. You're going to be looking for the unconditional approval of the board of directors of the co-op. It's usually what's involved in this process, in both processes, is submitting a board application and probably having an interview. Next slide, please, Danny. Thanks. So some of the differences between condominiums and cooperatives are also the closing costs. One of the benefits of a cooperative is that the closing costs are slightly less, and I'll go through the reason for that. So first off, on both of these, you're going to have certain fees that are payable to the bank. These are going to be things such as credit report fees, appraisal fees, origination fees, a lot of the things that Michael touched on. What's important to know here is a lot of times you have clients who purchase a place, and just to use round numbers, it's $1 million, and they say I'm putting 20% down and going to get 80% financing. So they think I'm going to need another $100,000 at closing. I put $100,000 down at contract signing, the 10% deposit. I'm going to need another $100,000 at closing. You're usually going to need a little bit more than that. The reason for that is you're getting a loan for $800,000 in our 1 million example, but the bank is actually only going to bring something like 756 or 757 to closing, 796 or 797. I'm sorry, bank fees are not that much. And the reason for that is because the bank is going to take their fees off the top. So the money that you're going to need at closing is going to be slightly more than what your 10% deposit was. It's going to be slightly more than 10%. You're also going to be responsible for legal fees, which depending on what you're purchasing and the complexity of the deal could vary a little bit, but generally you're looking at a couple $1,000s. The main difference is in a condominium, you're going to have to purchase what's called title insurance. Anything that's real property, considered real property in the eyes of the law, which would be a condominium or a house, you're going to have to get what's called title insurance. Title insurance could be a little bit pricey. When you purchase title insurance, it's about 0.5% of the purchase price. You also have maybe $1,000 in search fees, and then you have some additional taxes, which really are the pricey ones. Now, one tax to consider is what's called the mortgage recording tax. Every purchaser in New York City who purchases a condominium or a house is going to pay mortgage recording tax at closing. Mortgage recording tax is just under 2% of your loan amount. So it's about 1.925%. Okay, so in our 1 million example, if you're getting a loan for 80% of that, 800,000, you're looking at mortgage recording tax of about 15,500, which is a fee that a lot of first-time home buyers aren't aware of, and could be surprised at if they don't get a list of all fees prior to signing the contract. Another fee to be aware of is what's called the New York City mansion tax. If you're purchasing something in a place in the 5 boroughs, now this applies for whether it's a condominium or a cooperative or a house. If it's over $1 million, you're also going to pay to the city of New York a 1% mansion tax. That's 1% on the purchase price. So in our $1 million example, that is going to be $10,000. Anything under $1 million will not have any mansion tax, but the mansion tax does increase on a sliding scale as you go up. The next increase is not until you get over 2 million, and so on. With a co-op, you're going to save quite a bit on title fees, and the reason for that is that you don't have to get title insurance, because what you're buying is not considered real property. What you're buying is you're buying shares of a corporation. A lien and judgment search is typically going to be a couple $100, somewhere between $300 and $500, most likely. What a lien and judgment search does is it searches the shares of the corporation for any UCC1s or any judgments filed against those actual shares of the corporation, or any judgments against the sellers. So what you would really be looking for there is something like an old mortgage, a credit line. You would want to make sure to catch any of those things early, so that way the seller can close them out or get a payoff to pay them off at closing, so that way your closing doesn't get delayed. Okay. You're also searching for any judgments against the seller. The last thing you want to do is to close on an apartment and then find out that the seller had a $50,000 tax lien against them that was filed, that the city filed against these shares of the corporation, and now you are stuck with that fee. Okay, you're stuck with that. The other fees that we have here, part of closing costs on a condominium, you're going to have some fees to management. Those are going to include, usually some sort of fees for the transfer, for the preparation of the documents on their part, maybe $500 to $1,000. You'll probably have a move-in fee, again, somewhere between $500 and $1,000. A lot of times the move-in fee is refundable as long as you don't cause any damage on your way moving in. In a co-op, the fees are going to be pretty similar, except you're also going to have to pay the transfer agent a fee. The transfer agent is the co-op's attorney. They're going to need to prepare some documents. On the purchase side, you're probably looking at roughly $500, and on the selling side, you're probably looking at closer to $1,000 in most cooperatives. Next slide, please. So first, I'm going to take a look at the right side of this and kind of walk you through the process from the time you have an accepted offer, like Danny mentioned, to getting into contract, to getting all the way to closing. So one of the first things that we're going to do is we're going to begin all our due diligence on the file. This is going to involve things like reading the board minutes, whether it's a co-op or a condominium. When we read the board minutes, that's reading the monthly meeting of the board of directors, of management, to see what exactly is going on in the building. Now, when we're going through that, what we're generally looking for is things like, future major capital improvements that could cost you a ton of money. If you're buying into a building that is about to undergo, local law 11 work that is going to cost the building $1 million, or if they're going to redo the elevator, something like that, and you're going to get a substantial assessment or a substantial increase in maintenance, well, we'd kind of want you to know that, and your lender would also. We don't want you to walk into a place where you think your maintenance fee or your common charges are $1,000 a month, but you're walking into a $500 monthly assessment on top of that for the next 3 years to pay for these various repairs that the building needed. Another thing that we're taking a look at is we're looking at the building's financials. I had somebody come to me, this was maybe 2 years ago, and they were looking to sell their apartment. It was beautiful, you know, 1 bedroom on the Upper East Side, and the purchase price, the selling price was under 200,000. You say, how could that be? The reason that it was that is because this cooperative was built on a land lease property. So the co-op itself didn't actually own the property, and the land lease was expiring in the next 10 years. So those unit owners were going to lose their shares of the corporation and their proprietary lease to live in that unit unless the co-op bought it. The projected cost of buying the land from the original landlord, they were projecting it to cost each unit owner about $500,000 to $1 million. That is something that my client, when she was purchasing, had no idea about, because her attorney didn't look into the financials, didn't notice that this was a land lease building, didn't do his proper due diligence. I would never want somebody to be in that position. Another thing that we do is we review the offering plan and any amendments. We check the DOB site for any open permits. That's also something that your lender is going to look into. So you definitely want to have written into your contract that if there's any open permits, the seller is going to have to close them out prior to closing. Now, even if you have that in your contract, you're going to want to be aware of any open permits prior to going into contract. The reason for that is closing out a permit, even if it's just a matter of filing some paperwork, can take a substantial amount of time. And when you're purchasing, you may have your rate locked and you might not be able to extend it, or it may be costly to extend it. You may need to move because you're selling your current place, or your lease is expiring, or any other sort of time constraints. And your lender will most likely want to see that those closed out, or maybe escrow some funds to protect their investment as well. As we're doing all our due diligence, we're also negotiating the contract. So typically, the original contract will come from the seller's attorney. We will review it, we'll mark it up, send our comments, and we'll also attach a rider, which will have all these additional protections. So the term "as is" thrown around a lot in real estate. What "as is" generally means when you're on the buyer side is it means really two things that are going to be important to you. It's going to mean that at closing, the seller has to give you the unit in the same condition as it was when you saw it, and at contract signing, at closing, okay? Subject to normal wear and tear, of course. So if there was 10 scratches on the floor, you're getting it with 10 scratches on the floor. The seller is not obligated to fix those scratches unless you write it into the contract that you want him to make that repair prior to closing, okay? It also means the opposite. If you have a brand new floor there, and when you go see the place, when you do your final walkthrough a day or two before closing, and the seller has completely damaged the place while he was moving his furniture out, then you would want to ask for a credit of what it's going to cost you to repair it, because you are entitled to brand new floors the way it was when you saw it. The other thing is, we'll work into our riders representations that all appliances, utilities will have to be in working order at closing. What that's going to mean is if there's a 10-year-old refrigerator in there, it's got to work the way you would expect a 10-year-old refrigerator to work at closing. Otherwise, you're going to ask for a credit of what a 10-year-old refrigerator is worth, not what a brand new refrigerator is worth. It also works the opposite way. If there's a brand new Sub-Zero in there that's worth $10,000, the seller can't replace it with something that's $200-300 from Home Depot and say, hey, I'm not only giving you a working refrigerator, but I'm giving you a brand new one. It doesn't work that way. It has to literally be in the same as-is condition. And Danny could tell you he does a very thorough final walkthrough with every single one of his clients to make sure that they're getting exactly what they bargained for. And that's very important to us because as attorneys, we don't physically see the apartment before contract signing or even after contract signing or before closing. Now, it's very important that if you're going to do something like an inspection, like Danny mentioned, you do that before going into contract signing and you're proactive about making that decision. And the reason for that is once you go into contract signing, if there's something that's not working properly, you can't turn around and ask the sellers to correct it. I mean, you can, but they're not going to be legally obligated to. If you do the inspection before, you can tell the sellers, hey, listen, I like this place. You accepted my offer, but I want this corrected, or I want a credit in this amount for me to fix these issues that came up during the inspection. And then the sellers can either agree with you or they say no, but you know whether you have or not you have a deal. Once we finalize the contract, that's when I'll do a final review. We always do an initial review with the clients when it first comes in from the seller's attorney. But before we're ready to sign, we'll do a final review with the clients where we'll also go through a full estimate of all these title costs. So we'll get all the costs from management. We'll get you together a title invoice so you know exactly what you're going into. You'll know your attorney fees. You'll know any flip tax. So you'll know exactly what you're getting yourself into before you sign the contract and it's legally binding on you. Once we go into contract, we're going to order either a title report if you're buying a house or a condominium, or a lien search if you're buying a co-op. And we're going to review those and let the seller know of any issues that they need to clear before closing. So that way there's no delays. We always like to be proactive about that. After that, once you'll be simultaneously working during this period while we're handling the legal side. You'll be working with your broker to submit your board package, and you'll also be working with your lender to get your financing in order. Okay. Once those two things happen, then we need to wait for your loan to actually clear and schedule a closing date. And once you're approved by the board, we schedule a closing date and start moving towards closing. Once we schedule a closing date, then we let you know all the preparation that you need to make for closing, which is generally just bringing some checks and showing up. And we'll tell your lender how to cut the checks with the proceeds that they're bringing, and then we take care of the rest from there. I think that's all for me. Maybe just one thing that I do want to mention, because most people on most deals you do see financing. So one key thing, and I'm sure Danny talks about this with all of you, is when you're negotiating this, there's really three types of, when it comes to financing, there's really three kind of angles. The one is where the contract is contingent on financing, and you set out a certain amount, like 70% of the purchase price, 80% of the purchase price, 50% of the purchase price. Now, that's very important when you're negotiating a deal, because when it comes to us, if you agreed on only 50% financing and you're buying that $1 million house, like in our example, you cannot apply for a loan of more than $500,000. You can, but if you were to get rejected, you're not protected by the financing contingency of the contract. Now, if you apply for a loan of $500,000 or less, and you get rejected for that loan for any reason, as long as you didn't do anything to willfully get rejected, we can generally cancel the contract and get your money back. The other type of financing approach is when you're permitted to get financing and the seller will give you time to get financing, but the contract's not contingent on financing. So what that means is, I'm buying a $1 million house. We agreed that I can apply for 80% financing, but it's not contingent on that. So my $100,000 down payment, which is a 10% deposit, would be at risk if I cannot get financing. That's one reason why you definitely want to speak to a lender probably before making an offer. So that way you're comfortable with your offer and you're confident that you're going to get the financing. Making an offer that's not contingent on financing is definitely a more desirable offer for a seller. And then the last type is an all cash deal. Generally, that's when you cannot apply for financing. It's not just not contingent on financing, but you can't apply. And that deal will generally move quite a bit faster because you take out the 30 to 45 days that you need to get a loan. And you pretty much only need 30 to 45 days to close in that situation. So that's pretty much all from me, guys. If anybody has questions, I think Danny included our information. Feel free to shoot me an email. We could set up a call and go through the process more thoroughly. Happy to help everybody, even if you just have a few questions, you don't have, accepted offer yet or anything like that. Always happy to speak with anybody who has questions.
Yeah, tons of great information.
Thanks
Thank
again.
you so much. Thank you, Eugene. So yeah, like I mentioned earlier with Mike, there was tons of great information here with Eugene. So take him up on that offer if you ever want to chat through the process. So we're a little short on time. There are a few more steps I want to walk you through. So I'm going to pick up the pace a little bit. Right now we're in the phase where once you have a signed contract, you're then able to apply for your mortgage. And this is when you're going to touch base with someone like Michael Stein again. You're going to provide your signed contract along with a number of financial documentation. They're going to schedule the mortgage appraisal. And then eventually you're going to get your commitment letter, which means that they have approved you for this loan. And then, they're going to give you a number of items that you're going to need to fulfill in order to get that actual approval. In parallel, if you're purchasing a condo or a co-op, we're going to work on the board's purchase application. And this is where they're going to want to know a little bit about you. So they're going to ask for a lot of similar documentation, such as tax returns, W-2s, employer reference letters, pay stubs, et cetera, et cetera. And we're going to work through this together as a team. So you're going to gather all the documents, and then I'm going to help you. Our team is going to help you craft the story to ensure that you have a great shot of getting approved by the board. Once we submit the application, you're going to submit any required fees that they have as well. And then this is when we wait for the board approval. So the management company of the building will review the package. Once they're okay with it, and if they have any questions, they'll come back to us. They will then pass it along to the board, and then the board will review it. And sometimes they review them ad hoc as they receive them. Sometimes they wait till their next meeting. So if there is a chance that this can take 3 to 4 weeks to even hear back on any determination. So once they have reviewed, they will then determine if they want to schedule a board interview. And this board interview, for the most part, it is the board looking to meet you as somebody joining their community, as they like to think of it. And it should take about 15 to 20 minutes. They're going to talk through the house rules and answer any sort of questions you may have. And once the interview has taken place, you should hear of approval or turn down within 24 to 48 hours, typically. Once you've received that approval, we will then send off the approval to your lender and to your attorney. Your lender will then provide a clearance to close to the attorneys, and then we can schedule a closing date. And this is when the attorney is going to ensure that your title is clear. You're going to receive a disclosure about 3 days prior to closing with the money that you need to bring to the table, essentially. We will conduct that final walkthrough that Eugene had mentioned and make sure that everything is in working order as you expected. And at the time of closing, you will provide that remainder of your down payment. So if you remember at the time of contract signing, you put down approximately 10%, and now you're going to put down the rest. And once you pay your closing costs that Eugene had walked us through, you're able to get your keys and celebrate. And that is a conclusion of today's workshop. I was hoping we would have a couple more minutes to answer any questions, but please feel free to unmute yourself, and we can hang out for a little bit longer.
Yeah, definitely, Danny. I think we're here. So if anybody does have any other questions, by all means, we can stick around. And sorry for running over a bit, but yeah, by all means, we're here.
So we have included a few happy clients in our presentation here. Here's Molly. We've helped her buy and sell. And this is our contact information as well. So we are a team. And let's see, somebody in our chat. Oh, thank you, Lee. We'll speak to you soon. And I do thank each and every one of you for coming out today. Thank you, Michael. Thank you, Eugene. Tons of great information. We will share this recording with everyone, and we will also share some resources with you. So Eugene had shared a couple of documents. We have a few other documents that we'd like to share, and please look out for our email following. And thank you again, everyone. And I hope to be in touch with everyone soon. Enjoy this beautiful weather.
Thank you.
Thank you, everyone.
Bye.
Stan, thanks, Peter.
Thank you. Have a great day.
Thanks, Danny. Thanks, everybody.